much a trend. Most states in the country have changed to destination sourcing, and the idea is, trying to capture their reasoning will be to try to level the playing field. That's their favorite terminology of making sure that they're capturing as much tax as they could related to all products and services in the state coming in from out of state or within the state. That's mainly because the trend is going out and most states are transitioning. Of course, it's for economic reasons, so they can collect more tax and keep more tax in their state. Um, and the nexus rules have changed. The nexus basically means having a presence in the state. But ever since they made the change back in 2008 with the Supreme Court case of Wayfair, you guys know the Wayfair website where you can order everything online. With that change from the Supreme Court, that changed the nexus requirements. Now all the states are also doing the same so that they can do a destination source tax versus origin source. So what is nexus in terms of gross receipts and compensating tax? It's, basically your presence and in a state. Because of those laws changes, it now allows states to change to destination sourcing. So if there's someone to look at research, you can look at the Wayfair decision from the Supreme Court, which kind of originated and gave more power to each state to make this change. So New Mexico has changed its nexus requirements to being compliance with Wayfair. Same mentality. New Mexico can now tax and collect tax on more transactions. So used to be if it happened in New Mexico, then they could tax it. If it's out of state, it's a different tax rate, or you can't tax it. Now that they've made this change, doesn't matter where it originates, it matters where it ends. And then that's where the tax is going to be determined. Okay. New Mexico would not have been able to reach certain sellers under the old law, which is why they changed it. So the destination just kind of lays it out to, if you do business in New Mexico, you're going to have some kind of New Mexico gross receipt rate. On section 1-114, the statute of New Mexico law, the statute sets out the changes. I don't have a quick link here. I was going to have one for you, but if you guys want it, I'm happy to send it. Send me an email, and we could talk about it more. There are other changes, and some industries are more affected than others. So it's on a case by case. I don't know everyone's business that's online right now listening to me, but if you ever have questions related to yours, send them on in or send me an email later and we'll discuss. Because most of the time when you ask me a question, my answer is it depends. So I have to determine the industry and the situation, and then that'll help determine what the answer is going to be. So another effect of adopting this destination resource is to shift more of the taxes to the gross receipts instead of the compensating tax. So that's another reason why they did it internally. So categories of receipts. This change affects not only the GRT and compensating, but some other more limited taxes. So all this change is going to affect other taxes that New Mexico charges, like interstate communication, telecommunication, lease vehicle tax, sources in effect of the different economies that are basically your industries that might have some rule changes because of this. Transactions involving real estate property, sales of tangible personal property, leasing tangible personal property, transactions related to franchisees and professional services. These are some of the industries that are affected. Here are the codes if you want to go into that specific industry, if it's yours. Some of the easier cases that it's an obvious what the change is going to be. Transactions related to real property. They're going to be sourced at the location of the real property. So you sell a property, wherever you sell it, that the rates in that location are what's going to be used. There's not really a whole lot of change in there. Construction, the same. You're building a building. It's wherever the building is built. That's the location. So that one not as complicated either. So there's not really a whole big effect on those two industries. Franchises is one that could have an effect, and basically we're looking at it from the perspective of not the franchisor, but the franchisee. So I own Subways. I've got across town. Across the state. One in Santa Fe, one in Alamogordo, one in Albuquerque, so on and so forth. I pay franchise fees to Subway. That's outside of New Mexico or wherever the corporate office is. I now will probably get a different rate for each franchise fee that I pay per location. So depending on the rate, I'll get so my Subway in Albuquerque will get one rate. My Subway in Santa Fe could get a different one. If I have one in Lovington, that could get a different one. If I got one in Alamogordo, that could get a different one. So it's going to change because wherever my Subway is located, the fee was going to be adding on the gross receipts for that location. Sales of tangible personal property, basically products. That one is going to be the most complicated. There's still not a lot of regulation that has come out to help determine a lot of the questions that are going to be popping out. Remember that the statutes are what's the law, it's basically the law. Those have come out, but the regulations that give instructions and guidance on how to follow that statute is what we're still waiting on a lot of items. And tangible personal property is one of them. So be patient, tune in every once in a while, check in. You can go to our website as well or go at the state website because as they're pushing out regulations and changes, then we'll have more clear guidance. But tangible personal property, a lot of rules. The section 7114 is where you want to look. They're trying to avoid problems related to transfer of title, but it all depends when the activities occur. If the purchaser receives property at a place where the sale is made, then you use that location. The person selling can rely on the location of the buyer, but it doesn't have to necessarily be to the point where you need to know where the product's going to be used. For example, if I live in Las Cruces and I'm Lowe's, let's say Lowe's Home Improvement. I sell some products to somebody living in Lovington. I deliver it there. I would use the tax rate of Lovington. If they take it from Lovington and use it somewhere else, I just need to, wherever the destination ended, that's as far as I need to go as far as adding the tax for that sale. Okay. So you have to have a little bit of understanding of where the product's going to end, but it doesn't have to be to the point where you have to know exactly where the product's going to be. And then if you have a majority, you normally sell to this one place and they normally stay in that location, but once in a while it might go to a different location. The majority rule can be used to where if I usually have it in city A, and sometimes it goes to city B, but mostly it's city A, then I would use city A rates. Okay. Other rules apply if, use of business records of the seller. So basically, you're going to rely on what the seller gives you. If there's multiple locations, then you use the majority rules and use that as guidance. If you get confused or you're not really sure, you're welcome to send us an email and we can determine it based on your situation. Okay. Leases of tangible personal property is basically the same thing. Wherever the product is being used, a copier, I sell copiers and I'm leasing to companies in Albuquerque and Santa Fe and Las Vegas and different parts of the state. I would use the gross receipt rate for that city. If my product is being used mostly in Albuquerque and I send it to an office in Santa Fe for whatever reason, but the majority is Albuquerque, the Albuquerque rate is what I'll continue to use. Okay, the primary use means the place where the property is used the majority of the time. So the primary use is the terminology they use for majority of the time. Okay, but the seller is entitled to rely on the information provided by the purchaser or available in the seller's business record. So it's not altered by occasional or intermediate. It's just, if it's majority city A, you're going to use city A tax. Okay. Now services in New Mexico are taxed. I remember everything in New Mexico pretty much is taxed. Services in Texas are not, but in New Mexico it's mostly are. Okay. There are some changes depending on the type of service and the professionalism of the service. So taxation, it gets a little complicated. So you might want to do a little bit of research, make sure you have your statutes or call your CPA to get more research on it. That we continue to rely on the distinction between performance of the service and product of the service. So whether it's something that you're doing or something that you're installing are examples. There are the differences depending on what kind of service that you are offering. One is professional services versus others, in-person services versus non-in-person services. And determination of the nature of the service will determine the sourcing rules for that service. Okay, so sorry, it's never just black and white and one rate. There's always a question of it depends. So professional services. What is professional services? So the way the state determines a professional services, it's some kind of service that requires an advanced degree from an accredited or post-secondary education. CPAs, attorneys, engineers, or someone required to get a license from the state to perform. Again, the same ones, the ones I just mentioned, but it could also be, anybody that's licensed from the state could also be considered a professional service. Uh, but you should also check to make sure, because there are some services that may be thought of as professional and may not require a license. So you might have to double check just to make sure the profession you're providing is considered professional under the terminology of the state. Common sense or received ideas of what a professional service may be misleading. Same thing. So just make sure you have a clear understanding if your service is professional under the rules of the state. Not in-person services are going to be services that are professional but done online, not necessarily there with the customer. Once you determine that your service is professional, then you need to determine whether it's in person or not. So some examples: accounting, auditing, and tax preparation. For example, clients, a lot of it's done online now. We don't have to be there necessarily with the client on some services. So that's considered not in person. That could happen with CPAs, with appraisers, legal services, telehealth, doctors. I now going to the eye doctor. Sometimes you see the eye doctor via screen. They're not even there with you. That's an example of a professional service not in person. Now, these professionals will continue to use the business origin rate. So the whole purpose of this presentation was to tell everybody, hey, you now need to consider the location of where your product or service ends, and you're gonna have to use that rate, except for professionals, the accountants, the lawyers, the teledoctors. Those guys still use the origin rate. So if I got a firm in Las Cruces and I do services in Carlsbad or Hobbs or Lovington, my billing is coming out of Las Cruces. I'm going to use the Las Cruces rate. Only professionals. Everybody else is going to be destination. Confusing? Yes, absolutely. But that's why we're doing this presentation. So check with your CPA or professional, or give us a call to make sure that you're charging the right rate. In-person services, professional services are going to be, there's regulations also given common examples of in-person professional. Healthcare providers, doctors in the hospital, athletic trainers, physical therapists, barbers, cosmetology. As with non-in-person services, just because the services may be performed remotely, that does not make the services not in person. So let's say I'm a barber, I have my barber shop in Lovington, but sometimes I'll travel to Hobbs or Carlsbad and perform services there. But most of the time my work is done in Lovington. I'm going to use the Lovington rate, even though I traveled a little bit, but because it's a professional under the rules of the state, that's the rate that I'm required to use, my origin base. Everybody else is going to use destination base, okay? So there's always special rules at the same time. So you gotta look at each situation and determine which rate you're going to use. Okay. Other services. So the rules are the same for in-person professional services. You still have to define the product of the service, and there's going to be more regulations coming. So a lot of the rules, as I mentioned, we've got the statutes, when the laws have been in place, they're now implemented, but a lot of the guidance on how to follow those rules, follow those statutes, or be in compliance with the statute are still coming out. There's special rules for advertising, for example, that are specific. I mean, it's you got to really do your research. And I'll tell you that the states, New Mexico, Texas, so on and so forth, if you come in and you get audited by them and you're not charging the right rates, sometimes clients will say, well, you know what, I didn't know the changes of the rules, I didn't understand them. Sometimes the states are pretty unemotional on the whole thing, and they'll just say, you as a business professional, you should have been calling the state. You are required to understand and know what the rules, which rules apply to you, and implement them. So they don't have a lot of uh, sincerity, or they don't have a lot of I don't know, not the word. They don't have a lot of patience or sympathy for you if you don't know. So that's why we're doing this presentation. If your questions aren't answered by the time we're done, please send an email. If you got your CPA, please call them. Make sure you get a good understanding, because if you get audited, the state is not going to take the excuse of I didn't know, and they're going to expect you to know. Okay. If you're in pueblos or other sovereign entities, the destination sourcing had already have been implemented, so they continue to work with them. So the reporting requirements. So since they made the changes of destination instead of origin, now there's some different requirements that come along with it. You know, sellers, purchasers subject to compensating tax must use the correct destination code when reporting gross receipts. Errors in the coding have a knockoff effect on local governments. What does that mean? So if I, in the example of a service that I do, and I provide services to, I'm from Las Cruces, and I provide services to Albuquerque, Carlsbad, and Hobbs, and I build and charge gross receipts tax only for Las Cruces location. I realize I did it wrong. I go back and amend. I now have 4 locations because I have 4 different rates. Then money's going to be coming in and out of the different states. So they could have sent different cities. So they could have sent money to Albuquerque. Then they got to pull it back, give it to Las Cruces, because the report was done wrong. So you're going to have a lot of money going back and forth while everyone's still trying to figure this out. You gotta understand the multiple locations and understand what reporting requirements you have. And the same for delivery or digital, same results. Destination is the key. This sounds complicated? Yes, it does. I'm even confused. So just be patient. Call your provider, your CPAs, call the state, make sure you have items documented. Rules are still being, guidance is still being populated and developed, so that we could get more questions answered as we go along. But know that there is a change. It started with the report that was due yesterday. So go back in your report, make sure you did it right. If you didn't, probably is a good time to amend now. Get your processes updated and changed. So when you do your report for August, which is due in September, you're more in compliant. The state does not ask, some people ask, can I go ahead and true up my differences? You know, if I should have sent this much in July and I didn't, can I go ahead and make my changes in September? Well, with my August report and true up there? The answer is the state doesn't really like that in New Mexico. They prefer that you amend and send in the correct information for the month incurred, and then do it correct from that point on. Okay. Will this cost more money? It could, because it could be more complicated depending on your service and the type of activity that you do and the locations of where you sell your products. If everything's in one city, you might not have a whole lot of change. But if you're somebody that sells services or products throughout the state, throughout the country, it's going to make some changes on your reporting requirements. Okay, so make sure you're well informed. Like I said, this is already changing countrywide, so it was just a matter of time before New Mexico got on the bandwagon. And the state will work with you, but it's probably best to try to make sure you get into compliance as soon as possible. All right, guidance and resources. If you're uncertain, ask for help. Ask your CPA. Get in contact with the state. State's got a new website. They got which has also been an adjustment as well, because they changed the way you log in. They changed their whole website, so some people have struggled trying to get in and find old reports and old information. But it's more up to date now than before, because as they were implementing the new website, they were updating all the data as well. I went in for a client who's got an office here in Horizon, Texas, and another one in Las Cruces, and I needed to get their CRS reports, and I was able to get in, and all the history was there. But about 3 weeks ago, it wasn't. So the state is continuing to make their changes and do their updates. Okay, so ask somebody. If not, you get pinched, you're going to have to come up with the funds and eat the tax, which is why we wrote that. If you have to do a change, for example, I did my July report. I did it all out of Las Cruces, but I really went to 4 different cities. And it's going to be really complicated to determine exactly what was sold in each city. The state will allow some reasonable estimating, just make sure you have good documentation, good supporting work papers to show how you came up with your numbers so that it's justifiable. I mean, if it's going to be, if I sell 10,000 products a month, and I know I did it in 6 cities, but I can't get you the exact number, or that's going to take a long time. I can use a reasonable amount for each state, each city, to determine the tax that needs to go to each city. But try to exact, of course, is always better, but the closest to exact that you can get. If you can't, just make sure you have good documentation to support how you came up with your numbers. Here's the section in case you want to determine the guidelines for estimating. Same situation is going to be for your marketplaces, co-signers, and commission agents. Destination is the key. So wherever the final product is delivered or processed is what you're going to use. So here's a little bit of a recap. How does destination-based sourcing affect reporting? So on the type of receipts for general services, in-person service goods, and tangible personal properties, you're going to change from origin to destination based. Remember, not professionals. Professional services, you're gonna basically, there's no change. You keep the origin base. If you're construction and real estate, it's really not change either because the destination and the origin is pretty much the same place. Okay. How does destination base affect reporting? It could be more complex, like we mentioned. So just make sure you're doing it right. Have somebody check it if you're not sure. And we could always give you an opinion, give you some guidance as well. Or you could also call the state. Okay. That's the basic showdown of the changes of the determining the tax rate to charge based on destination. So if you have questions, let us know. Let the state know as well, or your local CPA. And good luck on making the change. If you have some questions, just please give us a call. On the redesign and the upgrade of the CRS report as well, let's talk about that, because not only did they change the statute and the rules of how to charge the tax, they also changed the formatting and the presentation of how you're going to send in the information and the payments to the state. So in the old rules, you had a CRS report, and it basically had everything. In there, you could put the withholding you did from the payroll, the gross receipts that you charge your customers, and anything else specialized to your industry. It was one return that covered most of the tax, and it was long and a little complex, but it was one report. Now what they're doing is they're just basically let me go back. They now make tailored reports for each tax. So gross receipts has its own, compensating has its own, withholding has its own. So yeah, it's more forms, but it should make each form presentation a little bit easier. Probably your work papers are going to be more specific because it's going to relate only to that one tax. So hopefully it reduces errors, and it's intended to try to make it easier for you as the business owner. And it also makes it easier for them to review and determine that you charge the tax and collect it and pay correctly. So does more forms equal more work? Maybe, sometimes, maybe not. Just depends on your situations. Taxpayer filing only those forms that apply to them. Doesn't mean they have to do every single one, only the ones that you need to. And the majority only file gross receipts or wage withholding. So it's not going to be that much more work. But it should be easier to understand and to go through. Here's what the new and improved New Mexico taxation revenue website looks like. Here's where you log in to get into your own account. It's supposed to be more user-friendly. Actions are supposed to be, the actions are supposed to have more reminders and guidance for you, especially as the regulations are coming out. You should be able to function and go through it easier and find information. So they say there's an account center now to support tax practitioners, people like us that are helping to file reports or the challenges that clients have. There should be some information to help us as well, and some links. There's a new option to receive email notification and e-correspondence. We recommend that if you can sign up for that. and it is an improved refund process. So when the taxpayer submits an admitted return, it'll automatically prompt a request to refund. So hopefully, if you're owed money back, the process is quicker and you get your refund sooner. The ID number for the CRS ID numbers, most taxpayers use their CRS number as an identification for New Mexico. You'll continue to do that. They're going to change the name though. Instead of being a CRS ID, it's going to be a business tax identification number, a B10. It's going to be the new terminology, but it's the same as the CRS. If you want more on the redesign and names, here's some websites and links that you can go to kind of get more familiar. It's too bad that New Mexico and Texas are so different, but if you're doing business in both states, you got to understand the rules of both states and make sure you're reporting not only your gross receipts and sales tax correctly by state, but at the end of the year, when you're doing your federal income taxes, your annual, that you're reporting the correct shares to both states. For example, client might have an office in Horizon and an office in Las Cruces. All revenue earned generated from the Las Cruces office should be reported in the state return of New Mexico, and then all revenue generated from the El Paso location, whether it was work for Texas or other locations, should also be reported in Texas. So little things like that you still want to consider and learn. That's a whole other presentation, but just know that make sure you're talking with your CPA on the requirements by each state, not only from a gross receipts, but from income tax as well. There is a section you can subscribe to the New Mexico Taxation and Revenue. It's a YouTube channel. It's got a bunch of nice videos that you can look at that kind of talk in English to just give you more guidance and support. Everything we're presenting to you today was based off of a presentation from a couple months ago. Like we said, the statutes are now law, but the changes have occurred. They're now implemented, but the requirements and the guidance is still coming out. So tune in, stay tuned. There's always changes coming out. So it's just something that everyone's learning to deal with. Okay, that is my presentation on the CRS requirements and changes and the forming and the reporting itself. I do have some time to talk about the retention credit. Totally different subject, but it's a broad topic that we are talking to all our clients and everybody that we can, because it's possible that your company might qualify for some reimbursement of payroll taxes paid in 20 and possibly 21. So what is the employee retention credit? It is a refundable payroll tax credit intended to provide additional liquidity to the employers. Okay, eligible employers must it's an or. Okay, and they either had experienced a full or partial shutdown due to government orders as a result of COVID back in 20, or even possibly today, or they experienced a decline in year-over-year gross receipts during a quarter. So basically, you have to have a reduction in sales compared to the same quarter of the prior year. There's a whole process to calculate that, and there's even some look back and look forward options that you might run into to determine whether you qualify or not. Let your CPA know. It's a little bit not complicated, but there's a process to determine one or the other. And then there's some rules on what determines eligible depending on the result, whether you were partially shut down. The period of shutdown might be the only period allowed in the reimbursement, or if you had a reduction in sales, then you might be able to expand that time. So get with somebody that knows. Our firm does them, of course. We help clients first determine if they qualify, and if they do, then determine what their options are. And some clients have come out getting hundreds of thousands of dollars back in payroll tax refunds because they qualified. So this is something that doesn't have a timeline. It's really based on amendments of your payroll tax reports that have already been reported, or possibly if you know someone coming up in the current quarter, you can also reduce the amount paid or get a refund after you've paid. So check with your professional to see if you qualify. It used to be, and this is why the rule was kind of ignored, or the opportunity on the employee retention credit, because when it first came out, it came out at the same time as the PPP, but the government said you either do the PPP or the ERC. You choose one. But when Biden made some changes in law earlier this year, he changed the or to and. So even though you have PPP, you can still now see if you qualify for employee retention credit. So it's nice because you have until the end of this year to determine if you get an opportunity for a refund of payroll taxes. So for 2020, if you're looking at the reduction in sales, I'm sorry, in 2020, the qualifying wages of how much you can get back is going to be 50% of qualifying wages up to 10,000 per employee. So you got 100 employees, that could add up really quick. That's like I said, certain rules. You got to look at an area. You got to make sure you pass the threshold of reduction in revenue, so on and so forth. And then for 21, it's actually 70% of qualifying wages up to 10,000. So it also could be a nice number for 21 if you qualify. How does the employee claim the credit? It's basically if you confirm the shutdown or decline, make sure you have documentation that supports that. Report the qualified wages on your you reported everything on your 941s. You're basically going to do an amendment on the 941 so that you can request the refund. You got to monitor per employee maximums. You got to monitor the limits on the number of employees versus not working, employees working versus not working, and the owners are not eligible, so you can't include the owners on the list. Employees can also claim an advance if you know you're going to have an opportunity for a credit in the future. Then you could request the advance upfront. But there's a website if you want to look more on what the requirements are. Of course, call your CPA or call us if you'd like to look at it and determine if you qualify. So one thing you also got to know, if you did have PPP and you applied for forgiveness and you got forgiven, the payroll that you used for the forgiveness of the PPP, you cannot use for the retention credit. Okay, so there's strategy there. If you're planning to do both, try to use as much non-payroll costs for the forgiveness of the PPP so that you have more available payroll costs to use for the retention credit. Again, could get complicated, call your CPA to determine. Here are firm values just for us. We always try really hard to make sure that we're communicating as much as we can to our customers and to non-customers, but the community. We're really happy and honored to be able to work with the chamber to provide this information to you. I hope it was information that you could use. I know it's New Mexico, but I know a lot of customers here in Texas and El Paso do business with New Mexico. Sometimes you all think it doesn't apply to you because you don't have a location there or nexus. That doesn't matter anymore. Wherever your product ends is where you need to charge tax. Okay, so give us a call. Here's some of our links, and this is everything that we're connected to. I really want to thank everybody. Oh, I didn't update the presenters. I was supposed to put myself, but everybody already knows who I am. So that's all I've got. Charlie, I don't know if there's any questions.
Great. Actually, we do have a couple of questions. One question is, how does this change affect online businesses or online hosts such as Etsy, Amazon, and Shopify? Are they responsible for adjusting tax?
So that's a very good question. And that's what really triggered everything, because online sales have been going up, and that's what caused that Wayfair judgment a few years ago, because online sales were avoiding the state tax because they weren't in that state. But because of that changes, because of the rule change in the Supreme Court from that Wayfair settlement, it is now not it. The answer is it's the same effect, whether you're selling online or you're selling physically. Wherever your product ends in New Mexico, you need to charge the grocery receipts tax for that location. If they want to, if you can give them my information, Charlie, we could talk about a little bit more. There's always an it depends in there somewhere, so we would just want to get more understanding of what they sell exactly. But more than likely, the location, destination, that tax is what you're going to need to charge.
Great. Okay. Well, if we have any more additional questions, please feel free to leave them in our chat. Or if those who are watching Facebook Live, you can leave them in the comment section. I will go ahead as well after the presentation. I will email everyone who did attend and registered the slides, as well as Mr. Michael White's information, contact information, if that's okay, in case you would like to get in touch with him. So let's see, I'm going to go ahead and share my screen.
Okay.
Again, if there's any questions, please let us know. It doesn't look like we have any. So we're going to go ahead and just close out. Thank you again, Mr. White, for presenting for us today and giving us all this resourceful information. And for those who joined us, hopefully you can join us for our next webinar. It will be with Hello Amigo on September 23rd, operating in a digital world. Again, I'll go ahead and email the presentation to all those who attended, as well as Mr. Michael White's contact information. So thank you.